morning and welcome to our seminar. My name is Warren Dueck and I'm with my colleague Atif Mir. Atif, good to see you this morning. Atif's in Calgary, I'm in Vancouver.
Hello,
and
Warren.
we're going to talk about a really wonderful subject. This is almost like Christmas cheer here, death and taxes, Canada and the U.S. Tax 101. So Atif, are you ready for this?
I'm ready for this, Warren. As they say, that death and taxes are certain, but death is death, but taxes can be reduced. So that's the silver lining there.
Ooh, that sounds like you're selling. Yeah, and we did a seminar, we did a webinar on this just a couple of weeks ago on estate planning. So we're taking a little different angle on this. We're going to talk more about cross-border scenarios and issues that can affect people. So we're going to walk through this. We're going to have time for questions. So make sure you go ahead and submit questions online. We'll answer them at the end. After the webinar is over, there'll also be a survey sent to you. Please complete it. We'd love to have your comments and thoughts, ideas. We do read them and we see your questions. We can't answer necessarily all the questions, but we'll answer a whole bunch of them there. And there's also a closed caption transcript there too, if that's helpful for you. So we're going to talk about cross-border tax scenarios, and we're going to talk about cross-border tax solutions, issues and solutions. And then we're going to talk about tax compliance in Canada and the U.S. And that'll be fairly brief, but it'll give us a chance to kind of walk through the key issues for you. And I know there's some people in our audience that are concerned about forms, so I want to make sure we talk about forms. But we also want to talk about issues and, best of all, solutions. So with that, I'll pass it over to Atif, and you want to talk about cross-border tax, death of a Canadian. What a rosy subject.
Thank you, Warren. So taxes upon death can be a little bit of a complex affair, but add the element of cross-border there, and suddenly the complexity goes up further. So to organize our presentation, we have come up with 5 scenarios. And these are the 5 scenarios we will discuss in our webinar and elaborate upon using some discussion points as well as examples. The first is that when a Canadian passes away, they have to be aware of their residency and citizenship. So what that means is, let me clarify, residency has nothing to do with immigration residency. You can be non-immigrant resident, but still a resident for Canadian tax purposes. Basically, what they look for is your ties with the country in which you're living in. And if you have strong ties with Canada, you will be taxed on your worldwide income. However,
if someone has no status in Canada, but they actually live here,
yes,
temporary or otherwise, they may be a Canadian resident for purposes of Canadian tax.
Exactly, Warren, exactly. And now, if that person that Warren mentioned has U.S. citizenship, things get a little bit more complicated. So we will talk about this scenario. If you are Canadian and you have investments, securities in the U.S., again, you need to be aware of both, not just the Canadian taxation rules, but as well as the U.S. tax rules. The third thing is estate and trust residency. So when a Canadian passes away, assets are flowed to his or her estate. And the residency of the estate, again, can trigger complications that you need to be aware of. The third scenario we will discuss is U.S. resident beneficiary of Canadian estate. So if a father passes away and they have everything is passed on to his estate, and he has a kid in the U.S. working in the U.S. who's the beneficiary of that estate, again, we need to be aware of certain rules to avoid. Go
So
ahead,
this
Bob.
is this becomes more common. I mean, the scenario typically is this: is Canadian family, their kids go to school in Canada, and then they decide to go to university in the U.S. And
Yes,
surprise, shock to all parents out there, they meet the person of their dreams in the U.S., get married, and suddenly they're living in the U.S. And some of that estate planning you've done may be kind of out the window here,
exactly.
and it may be impacted by the status of where the beneficiary is resident.
Exactly. That's why, I mean, this is one of the very, very common scenario, Warren. Thanks for bringing it up, that if your kids move there for education and get settled down there, have their own family there, then you need to be aware of the tax consequences for your estate. So something you should be aware of. You should not just make a plan, but also make sure that your plan is updated if the circumstances change. The fifth scenario we will discuss is Canadian with U.S. real property. And it's -20 in Alberta right now in Calgary. So if I go to US and I really like a vacation property there, and if I buy it, suddenly I can be caught in certain tax rules that I might not be familiar with when my assets go to my estate. So these are the 5 scenarios around which we have organized our webinar. And
Excellent. Atif, I like your reference to saying it's -20 in Calgary. Obviously, people have a different view of what's cold. In Vancouver, one of my neighbors said to me the other day, I said, "Oh, it's a pretty nice day." This was a week or so back, and I said, "Yeah, it is." He says, "But he said, he warned me, it's going to get severely cold in Vancouver. It might drop down to -2." So
everything is relative.
exactly. So we'll move on to the a little bit of an overview. Canadian resident, U.S. citizen at death, and what are the tax implications? And the tax on a worldwide estate, I said 27%. It actually varies depending on what province you're in. Alberta is about 24%, BC and Ontario are 27%, or just actually a little bit under that. And the top rate for U.S. estate tax is 40%. Now, there's something really important here, because we talk about tax rates, but sometimes people don't understand what the tax is actually on. And in the case of Canada, Canada taxes unrealized gains. And I'm going to give you an example of this in just a moment. So, if you have cash, there's no unrealized gain on cash. But if you own shares of Apple and you bought it for $10 and now it's worth $50, there's a $40 unrealized gain, and that's the gain that be subject tax at death. Conversely, the U.S. doesn't tax the unrealized gain. It taxes the fair market value of an asset. It's actually the net fair market value, to be precise, because it's reduced by certain debts that will reduce that amount. And I'll show you this example here that will surprise some people. Someone dies, they have $100 million of cash in the bank when they die. So their Canadian tax at death is 0, because there's no unrealized gain. But the U.S. tax would be $40 million potentially. 40% tax rate, $100 million of cash. The U.S. is an estate tax, and it's taxing that fair market value. Now, if this individual had a $60 million loan, it would reduce the taxable portion from $100 million down to $40 million. But there'd still be a substantial liability there. So, this is one of the advertising campaigns that you've never seen in Canada, but it may be something we're thinking about. The U.S. income tax are generally lower than Canada and often very attractive to Canadians. But on death, the U.S. becomes a very expensive place, potentially, especially for those that have not made plans to minimize the tax. Canada, conversely, tends to be a cheap place to die. So somehow we haven't got that into our psyche, thinking how lucky we are to live in Canada and die in Canada. that's not selling a lot there so far. So comments or questions that Atif?
Now, suddenly I feel lucky to be living in Canada, Warren. Thank you.
There you go. Now, I will raise one point is, what if, would it make a difference if we didn't identify the currency, it was $100 million US cash at the date of death. So would there be a Canadian tax at death? Well, there could be, because it's always marked between the fair market value at the date of death in Canada and the cost. And so if you bought $100 million US cash and it was, you bought it for $110 million Canadian and at the date of death, it's $112 million Canadian. Yeah, there could be a change there.
Right. Yes, because that will be based on unrealized gain or realized gain at the time of death.
Canada always pulls it back into Canadian dollars, and in the US, it's based on US dollars conversion there. So we talked about the problem now. What are the solutions? And we identified some solutions. And Atif, you want to talk about the Canadian ones?
Of course, Warren, as you said, that it's cheap to die in Canada, but it can be a little bit more cheaper. One of the the surviving spouse. So if you pass away, and if your wife or a husband receives an asset, then that is not subject to tax until the second spouse has passed away. But make sure in the will it's clear that you are leaving this property to a spouse, just to make things simpler after you have passed away. Lifetime capital gain exemption. If you are a business owner and you pass away, and if you have common shares of your corporation that is operating a business, then those shares will be disposed of at fair market value as well. And those shares will be treated as if they have been sold, and the gain will be reported on your tax return at the time of the death. And that could be very, very significant tax liability depending on the value of your business and the cost base of the shares of the corporation. Now,
so that exemption is worth about $900,000, just over $900,000.
Right. It's indexed to inflation, so it adjusts, it goes upward every year. I wonder how much will it go up next year, given how much inflation we have right now. Yeah. So one of the things you can do, which just doesn't apply to business, but other assets as well, is to be proactive and do estate planning. So estate planning is when you come up with a plan of how to distribute your assets to your family members or charitable causes. You come up with a plan, as well as it allows you to minimize your liabilities. So when you do a estate plan, you freeze the value of your business shares and issue pref shares to yourself. So you are freezing in your value of the company that you own in pref shares, and you issue common shares to your kids. So let's say 10 years ago, you have done that plan. Then if you pass away today, then the gain will be the fair market value that will be reported on your tax return for the gain purposes will be based on what it was 10 years ago. So estate planning is always a good proactive strategy to keep in mind.
Now, just on that point, an estate freeze is a great Canadian tax planning idea.
Yes.
It does not work for US tax purposes. What happens is it's treated as though the person who's doing the estate freeze and taking back preferred shares is actually cashing out and making a gift. Mm-hmm. And so you end up with an adverse, or I should say every situation is unique. You may very well end up with an adverse US tax result that makes an estate freeze not a viable solution. But this is kind of the issue here is that we're dealing with is we have a solution that works in Canada, but doesn't work on the other side of the border.
Right. And yes, in some cases, it will spoil the planning. So you have to be aware of it case by case basis. Thanks for that point, Warren. The other point is carry back losses from estate return to personal return. So what happens is if you have assets that are deemed to be disposed of at the time of your death, and you have a gain of $100,000, and that asset now gets passed over to your estate, let's say the shares of a company, And if you don't want to continue operating that company, then you can liquidate that company. And it will trigger a capital loss that you can carry back on your personal tax return and offset the liability. So that is one of the plans available. Again, it depends on case by case basis. You have to think about other pools inside the corporation, CDA, RDTOH, whether you want to continue the corporation or not. All those factors go into play there. So what you have done is you have converted the capital gain in, you have offset the capital gain using the capital losses of the estate tax plan.
No,
And
just if I could jump in, you said some things really fast, CDA and RDTOH, you know how I feel about acronyms.
yes,
And the issue here being is, without kind of going into the detail here, there's a bunch of issues in here. And, this is a chance to look for opportunities.
yes. Thanks, Warren, for keeping me in line there. I tend to float into the technicals there sometimes. So sometimes, again, bottom line, be aware of your situation, case by case basis. This plan can work, but not always. Pipeline for private corporation, again, a very popular tax strategy. What that does is that in simplest possible language, and Warren, you can jump in if I get complicated here. When the shares of the company that you own, when you pass away, they are deemed to be disposed of at fair market value. So you have paid tax on it, and hopefully you have used the lifetime capital gain exemption on it. But if there's still tax owing, you have bumped up your cost basis in those shares. Now that tax attribute can be used as an effective tax plan when you transfer your shares of your operating business corporation to a holding company. Without going into the detail, that allows you to pull out some of the capital from your corporation with minimal tax consequences, in some cases minimal tax consequences.
And again, here's a situation where you have to overlay this saying, here's a great Canadian tax planning idea. What are the U.S. tax consequences? They're going to be governed by the individual situation. This gets particularly attractive where you have a beneficiary who's not a U.S. citizen. It's more troubling and it requires more attention where the beneficiary is a U.S. citizen.
Right. And the last point is treaty U.S. tax creditable. So I'll refer you back to the point that Warren made about pref shares, that they could be subject to taxation under the gifting rules, Warren, you were saying. So in some scenarios, depending on what the facts are, what the tax outcome is in Canada or U.S., you can reduce your tax liability by using the U.S. taxes, using them as a credit against your Canadian taxes. So on that point, I give it back to Warren for the U.S. taxes.
So again, these are just some basic planning ideas here. They're not, every situation is unique and they're not everything. And one of the important things to note is that while U.S. and Canada have a lot of similarities, especially in tax law, it's the differences that count. So you can defer tax by transferring assets to the surviving spouse, but the surviving spouse must be a U.S. citizen. Now, I said citizen, not resident. They must be a U.S. citizen. So it's not good enough if they live in the U.S. They have to be a U.S. citizen to receive assets from the estate. And now people think, well, then my spouse, I'll make sure they become a U.S. citizen. That may not be the best tax planning idea, because that means if they're a U.S. citizen, that the estate will definitely pay U.S. estate tax. There's a bunch of plans there that kind of take out saying, get the money away from the U.S. citizen and into the hands of a non-citizen spouse. There is a $12.06 million exemption from U.S. estate tax. That's for 2022. In 2023, I can't remember exactly the amount, but I think it goes up to, it's almost 13 million. And that's based on inflation. The interesting thing is this all changes in 2026. This particular provision sunsets at the end of 2025. In other words, that $12.06 million and almost $13 million for 2023 suddenly drops down to be about $6 million. Now, if inflation continues, it may be higher than that, but it radically changes in 2026. So you can't do estate planning based on the 2022 numbers or 2023. You got to think past that point in time. Other planning alternatives here are gifting over a lifetime. U.S. persons make a gift of $16,000 per year per recipient. That doesn't sound like a lot, but if you think about it, that you've got a child that you give money to for the next 40 years, suddenly you're talking about over $600,000. And if they have 2 children, then suddenly we're talking about, $1.9 million. So it's really about doing this on a regular basis. One of my very first assignments as a new CPA was tracking on like a 16-column spreadsheet by hand, by the way, for those of you who don't know that, tracking the gifts the family would make to all their children, their children's children, their nephews, their nieces, all these family members in an attempt to get the assets out of the estate. So lifetime gifting can be a very attractive thing. There's a bunch of other more sophisticated tools. They're frankly too complex to get into. They're beyond the scope of this. Grits and grats and things like that. In the U.S., the Canadian tax is creditable against U.S. estate tax. In other words, Canadian income tax at death is creditable against U.S. estate tax. That's only available under the treaty. It's not available otherwise. So Atif, I'll pass this over to you, a Canadian resident with U.S. securities at death.
So, thanks, Warren. So think of yourself, Canadian resident, and you are not a U.S. citizen, and you own Apple shares, and their value is $100 million. The cost base, let's say, is nominal. And if you pass away, how much Canadian tax will you pay? And will you pay US tax or not? And if yes, how much? So Canadian tax at death will be around $27 million. We are using the highest capital gain rate from Canada here. So now this next line might surprise some people, that you will be subject to $40 million of US taxes at death, even though you are not a US citizen. Now, the question that comes to mind is, I buy Apple shares, let's say, on my stock portfolio, and I assure you they are not worth 100 million, but are they subject to US estate tax as well? Like this, in this case, so US tax at death, $40 million, that's 40% estate tax. The answer is, it depends. Now, I refer you back to one of the slides that Warren was presenting, that there is a $12 million exemption available for estate tax. So if you have Apple shares which are worth less than $12 million and you have no other US assets, then maybe you're okay, you can sleep well at night. But if it is starting to go over 12 million, then you should do some sort of planning. So that is something that catches people by surprise, Warren, is it?
Oh, absolutely. And I think that, investors should be thinking about, firstly, I mean, we're not investment advisors. I know we have a bunch of them on here, and I'd always say, make the investment decision first, but consider the tax consequences that may come from it. If people are holding large positions in US securities, and I'm going to focus actually on equity securities, I'll make a comment about debt securities in a second, but equity securities, they should be thinking they need to protect themselves from the exposure to US estate tax. Now, there's a bunch of ways to do that. We're going to talk about that in a second. And I'll also mention about debt securities. Debt securities are generally not subject to US estate tax. Now, there's a bunch of rules that are way beyond the scope of this presentation, say exactly what those are, but holding bonds from General Motors, having a bank account at Wells Fargo in the US, Those things are not generally subject to U.S. estate tax, but securities issued by U.S. corporations are subject to U.S. tax. If they're issued by, Apple, General Motors, Microsoft, they're subject to U.S. tax. There was a point in time where I think there used to be Ford of Canada, and they actually had their own shares issued in Canada. That would not count for this, but that's a pretty rare thing. I don't even know those shares still exist, but yeah, it's a big hit there. So do you want to push to the next slide there, Atif?
So,
Was that a yes?
yeah, I think this is your slide, but I can take it.
Well, I'll go here. So the U.S. estate tax is creditable against Canadian tax, but it's only on the gain subject to U.S. tax. So if you look at that example back just a moment ago here, we got $100 million and we have a $27 million Canadian tax. In other words, you can use the U.S. estate tax of $40 million. You can offset the Canadian tax entirely, but you're still going to pay $40 million in total to one of the two countries. And there's no credit or deduction on the excess U.S. estate tax. Now, things that are subject to U.S. estate tax, those are securities that you own personally. I've got an account at, and I should be careful, a Canadian investment advisor. I know we've got a bunch of them here listening to us. It doesn't matter where, or it's with, Morgan Stanley in the U.S. Or Goldman Sachs in the U.S. It doesn't matter where it's owned or where the shares are actually held. If you own them personally, you're subject to U.S. estate tax. That's also true if you put them in a trust that is a grantor trust for U.S. tax purposes. I can't say this unequivocally, but most Canadian trusts will end up being a grantor trust. That typically is because the grantors have too much control associated with that trust. They can take the assets back, and it's a trust, but for U.S. tax purposes called a grantor trust, which means it's all owned by the grantor. If you have a partnership with U.S. business activities, that can be subject to U.S. estate tax. Ownership of shares of Apple through an RSP, RRIF, TFSA, other registered accounts are taxable to the individual. They don't not protect some from U.S. estate tax. They may defer tax for other tax purposes, income tax purposes. And remember, we're talking about a Canadian person with U.S. securities that's not a U.S. citizen. So that Canadian person would not otherwise be subject to tax on that.
So Warren, if there's an RSP account and let's say it has accumulated $20 million of fair market value of assets, so the taxpayers should be doing the analysis to figure out whether it's in excess of $12 million there that is coming from the U.S. securities, correct?
That's essentially right. I mean, you got to look at all your U.S. assets to make sure they're not over $12 million. We'll kind of get on that point about how that exemption works here in a bit, but that's right. If you have a substantial position, if you actually have more than $60,000, you're going to have to file a U.S. or the estate will have to file a U.S. tax return, a U.S. estate tax return. It doesn't mean you'll be subject to tax though. So Canadian resident with U.S. securities, the thresholds, there's no U.S. estate tax if there's less than $60,000 of U.S. situs assets. So if you have $50,000 of Apple shares and that's your only U.S. asset, Apple shares, U.S. securities are a U.S. situs asset. U.S. real property is a U.S. situs asset. If you have your Van Gogh or your Da Vinci painting in the U.S., that's a U.S. situs asset. It's personal property located in the U.S. If the total of all those is less than $60,000, you have no U.S. estate tax, and you don't have to file an estate tax return. If you're over the $60,000, the estate does have to file an estate tax return. And in order to avoid U.S. estate tax, you need to claim under the treaty the $12.06 million exemption that Atif referred to. And this does not mean that your worldwide estate is subject to U.S. estate tax. It does not. It's just a means of qualifying how much of a credit you get. But if your worldwide estate is less than $12.06 million, and these are US dollars, by the way, so less than $12.06 million, and you have the misfortune of dying in 2022, which means you don't have a lot of days left here, then you know, you will not actually owe a US estate tax if you're less than $12.06 million, the way the formula works. If your estate is worth more than that threshold, even though, and you've got more than $60,000 of US situs assets, I can guarantee you'll have a US estate tax liability. So even if it's relatively small, you'll have a US estate tax liability. So not subject to US estate tax. If you own those shares of Apple through a Canadian corporation, you don't have a US estate tax liability. Corporations don't die. If you own it through a Canadian or other non-US mutual fund or an exchange traded fund, an ETF, you would not be subject to US estate tax. The issuer of the mutual fund or the ETF must not be a US person. In other words, it's a trust formed in Canada or in France or Barbados. It's just formed outside the US. If it's owned, if it's a non-US grant or trust, it would also not be subject to US estate tax. Now, the last point of partnership, a partnership can meet this criteria, but it can't have any US business activities. So if a partnership owned shares of Apple and didn't have any US business activities other than the ownership of those shares, it potentially can avoid this. This goes back to a Supreme Court case called Blodgett. It was decided a long time ago. There's a lot of conflict on this subject. This becomes a very technical discussion about it. And be aware that the partnership, in order to exist for Canadian purposes, must have a business activity. It just can't be in the US. So we'll go to the next slide here. US resident beneficiary of a Canadian estate. Atif, you want to talk about this?
Yes, Warren, sure. Thank you. So envision the situation that there is a Canadian estate which owns a non-US Canadian corporation, non-US, non-Canadian corporation. And at the time of the death, the value of the investment inside that corporation was $10 million. And at the time of distribution, it's $11 million. And it earns dividends of $500,000 every year. Now, what are the results when the distribution is made and when the dividend is paid to the taxpayer, to the Canadian taxpayer? So if you look at the numbers, the gain at the time of distribution, between the time of death and distribution, the gain is $1 million. And using the 7% highest capital gain rate, the Canadian tax at the time of distribution will be $270,000. But if the dividend is paid and it is allocated to the US resident beneficiary from the corporation to the estate, and it is allocated to the US resident beneficiary, then the tax on dividend is $0. Now, what does that mean for the US tax?
Now, that $0 Canadian tax, and this is all a function of the fact that the dividend is coming from a corporation outside of Canada. And under the terms of the treaty, Canada can't tax it.
Canada cannot tax them, but there might be withholding tax. I mean, Canada will not tax them. Let's leave
Yeah,
it.
so it could be from a French corporation, and then there may be a French withholding tax. It could be from a corporation in the Bahamas, which doesn't have withholding tax.
Right.
There'd be no Bahamian tax, there'd be no Canadian tax. And then the question is there a US tax? So should we go to the US tax
Yes.
result here?
So the US tax will be nil altogether. Now, this might surprise some people. Warren, do you see this kind of setup often in your professional?
Well, unfortunately, most people don't actually think about this subject very much. But let's just walk through the details here. When the recipient and the beneficiary in the US gets the $11 million of value at the time of distribution, they pay zero tax at that point in time. But when they sell that, they'll end up with $1 million gain because their tax basis is the $10 million at the time of death. And so that gain is just deferred. But if you're going to hold on to these shares of this corporation indefinitely, you wouldn't pay that tax until you sell it or there's a death. The really interesting part here is with respect to the dividend income, because this sounds, if you're asked thinking questions, your mind's saying, surely this can't be true. It actually surprisingly is. In other words, the dividend was not subject to tax in Canada. It's not subject to tax in the US. And maybe it was subject to tax in France. Let's just say that withholding tax, which is pretty common, would be 15% from a treaty country. If it came from the Bahamas, it'd be zero. There'd be no tax payable on that. Is that too good to be true? In this case, it's actually true. It's a flaw, if you will, in US tax law that says that US beneficiaries of a foreign estate, an estate outside the United States, are only subject to tax on the income earned where it's earned in the US. And in the case of a dividend from a French corporation, a German corporation, an Australian corporation, it's not earned in the US, and consequently that dividend's tax-free. Now, the opportunity here is not really for smaller estates. If the estate is earning, let's say, $50,000 a year, then the tax saving, let's say the dividend we tax at, let's say a 20% rate in the US, you'd save $10,000 a year. That's great. Remember, you've got to go through some tax plan to get that result. But let's say you're talking about this one where we're talking about an $11 million estate, and this thing is churning out $500,000 of dividends a year. Your goal here is saying, don't distribute the assets to me, the beneficiary. I want to keep the estate around as long as possible because I'm getting $500,000 a year tax-free. That's a great result. Now, there are some tricks in here, and this is where it gets more complex, saying is, for US tax purposes, the estate will only last for 2 years, and then US courts have said it becomes a trust, in which case those dividends become taxable. They don't get the same treatment as coming from a foreign estate. But if the foreign estate is, let's say, a family business, or there's conflict in the estate, and the estate can't be wound up, the estate continue for an indefinite period of time. So, the scenario here really is where you have a US beneficiary of a Canadian estate. You should be thinking about saying is, maybe you don't want to distribute the assets from the estate right away. You want to keep the estate around for a while. So very interesting problem there. Should we go on to next slide?
Yes.
So
now we are getting into, I'm hoping that you guys are seeing the pattern here. So think of this situation, a Canadian resident with US real property, one of our scenarios. So if you have bought a vacation property in the US, or for rental purposes or for vacationing purposes, so on and so forth, and the owner of that property is Canadian and he or she passes away, what does that mean if the value of that condo or property is $1 million and you bought it at $600,000? Now, for Canadian tax purposes, the gain is $400,000, and using the highest rate, 27%, we have a tax liability in Canada of $108,000. And from the US perspective, again, we have to go back to that situation where you can be subject to a state tax, but that estate tax is exempted unless the value of that condo is more than $12.06 million. So if your condo is less than $12 million, don't worry about it from the US estate tax perspective. But if it is more than that, then you have to consider US estate tax.
Now, just on that point, I just want to be really focused here. It's not the value of the condo, it's the worldwide estate. So even if you have just $1 million condo in the US, but your worldwide estate is, 30 million or 15 million, I remember talking US dollars here, you're going to end up be taxable. And this goes back to the comment I made earlier. Canada may be a tax haven if you want to die in Canada, but if you have assets in the US, you may be subject to tax under jurisdictions.
Correct. And then, as Warren was pointing out, thanks to the tax treaty between Canada and USA, you can use the US estate tax as a credit against your Canadian taxes. But if you are paying more than $108,000 of Canadian US taxes, then the difference is not something you can deduct. It's lost. And watch out for the drop in exemption, as Warren has, I believe, mentioned before. It's going to go from 12 million to 6 million in 2026.
Yeah. So, here's the problem. What are the solutions? And we get asked this question lots. And I could spend several hours talking about these solutions. You notice there's an asterisk there. So some of these solutions are not necessarily great solutions. Income tax may be a lot less than the estate tax. So they, sell it before you die. Hey, if we could plan our deaths, we're tax people, we're not medical experts. So, and candidly, real estate's a tough thing to sell at a moment's notice. So that's a more challenging one. You can make a gift of the property, and that's almost never a good solution, gifting property, because that exposes the donor to US gift tax. And if the donor is not a US person, there's no $12.06 million exemption. That's only for US citizens or only for estate tax under the terms of the treaty. So gifting is almost never a good solution. The idea of gifting real property isn't. In fact, it makes more sense to gift money to, let's say, your child or family member, saying, I love you, here's $1 million. And the child takes $1 million and a year later says, hey, I want to buy that condo of yours. That's a better result there. Tenant in common, and this is converse from joint tenancy, is where it's tenant in common. A husband and wife will end up each buying essentially a 50% interest in the property. And that means that when one spouse dies, they're only subject to US estate tax on their 50% share. And that may solve problems there. But it also means that they might not gift that interest to their surviving spouse. Life insurance, life insurance is not the world's worst solution, but it may be impractical too. We were talking about a financial asset, life insurance, against a real asset that the property is worth $1 million now, but maybe worth, $5 million later. And suddenly, you've got a policy that doesn't make sense anymore. Non-recourse debt, not very common in Canada relative to the US, but it is there. Non-recourse debt means that the lender can only go against the property. If you default, they have to take the property. They can't sue you outside of that. As a practical matter, it's very difficult to get a non-recourse loan for more than 50% of the value, and if you can get it at all. So not very common. Life estate is another solution that, and it comes with an asterisk, like a lot of these do, is a life estate. What it basically means is that the person with a life estate, on their death, the property immediately transfers to another person. You need to set this up on purchase. It doesn't make a lot of sense in most cases, because what happens is the survivor has the remainder interest, and that remainder interest may have a nominal tax basis. So if they ever sell the property, they may get hammered with income tax. So life estate, yeah, it could work. Is it a solution? Yeah, it can. It has its own problems too. So identify these as non-entity solutions. I'll also give you some entity solutions. We talked about having shares of real property in a Canadian corporation. That protects you from U.S. estate tax. You can also have U.S. real property in a Canadian corporation. There's a host of issues associated with that, particularly with regards to vacation property or property that's personally used by the shareholder. So you've won the estate tax question. You may have created a Canadian income tax problem. And like anything here, it's in the absence of a silver bullet that makes everything work. You have to say, what works for you? How do you get the best answer for you? Trust is another tool there. Be very, very careful with trust. So, what typically happens is we have a client who goes down to Phoenix or Palm Springs and says, hey, Warren, I'm buying the property of my dreams. How should I own it? Should I put it in a Canadian corporation? Should I put, well, it's already too late to put it in the trust. Because if you buy the property, you've identified the property and put it in the trust, it's actually then a gift to the beneficiaries of the trust of U.S. real property. Now you're subject to U.S. gift tax. So be extraordinarily careful associated with trust. The ideal scenario there is you say you think you want to buy. What you do is you say, I want to give $1 million to my children, and or $1 million each. I'll be one of your kids for that. But you're going to put $1 million into the trust, and a year later you happen to be in Hawaii or California or someplace that's warm and attractive, and you say, hey, there's an ideal property here. This would be a great investment for the trust. Why don't I put this in why don't I have the trust buy it with that $1 million? Now you've avoided the gift tax issue that can otherwise come with a trust. So trusts, they're not an all-in solution. The limited partnership, we talked a little bit before about partnerships, and partnerships can be an effective tool. I've identified two things. There's don't check the box and check the box. There's actually a U.S. form that's one page and has one little box on it. And if you check the box, the partnership gets treated as a corporation for U.S. tax purposes. And if the partnership's formed in Canada, it's treated as a Canadian corporation. You've solved the U.S. estate tax problem. Now, the world isn't perfect in that. And so there's also the alternative of not checking the box and relying on the Blodgett case and the disarray that exists in U.S. tax law vis-a-vis partnerships. So that's a lot of information. Like I say, we could talk about each one of these for a long time. Did you have some questions on Atif?
No, I think you've covered all the angles here.
Okay, well, believe me, I haven't, but covering all the angles would exhaust all of us here.
I don't want to get too technical, Warren. I know you're watching me.
Okay.
So estate and trust residency. Now, this is the easy fix proactively, but if you don't do it, take care of it proactively, it can create some unwanted tax consequences. So let's say if you have passed away and the trustee of your estate or executor of your estate is appointed to be a lawyer or your friend who is in U.S. and you died in Canada, but the way the rules work is that the residency of the estate will be determined by where the trustee is resident, as long as that trustee is the mind and management of the trust. If he's making all the decisions, managing the trust, then the trust becomes the estate becomes the U.S. estate because the residency is of the executor or trustees in U.S. Now, what does that mean for Canadian tax purposes? Let's say if the if the estate has to pay dividend to a Canadian beneficiary, because then it could be subject to withholding taxes in the US. Or if the property is sold, if a taxable Canadian property is sold by the estate or distributed to the beneficiary, that could be subject to a rules that we call Section 116 that will require additional disclosure, additional withholdings, so on and so forth. And on the US side, because it is now a US estate for tax purposes, it will be required to file some US disclosure forms. So it creates consequences that you were not anticipating just by appointing someone as an executor or trustee who is not resident in Canada.
And the US rules actually, when it comes to the residency of an estate, and I'm going to make that distinction here. In other words, if someone dies and a estate is automatically formed, they're very parallel to Canadian rules. Where there's a trust, the rules in the US differ slightly. But I think the upshot of your comments, Atif, are if you have a decedent in one country, but the executor or the person operating control and management is in another country, you can end up with the estate or trust being actually taxed on that other jurisdiction and ceasing to be resident in Canada, or potentially being dual resident where it's taxable in both countries on its worldwide income. And again, every situation is unique, so I can't tell you that's a terrible problem in all situations, but it certainly drives up the complexity associated with that, and you end up with a trust or estate that requires more advanced knowledge than you might get from your local lawyer or CPA who now has to deal with multiple jurisdictions. So it really does, at a minimum, cost money in terms of the management of the estate or trust, but it may also cost in terms of taxes too.
Good point. Now, in terms of compliance, you cannot avoid compliance. You have to be aware of it. I think that is the next slide.
Well, just before we, just this last point about executors liable for decedent's taxes, and this is a really interesting one from a U.S. perspective. If the decedent was a U.S. citizen and didn't file taxes in the U.S., because the decedent has an obligation to file U.S. tax returns, and I'd say in many cases, and most cases, there may be a very low tax, if any tax is liable to the US, because that income may have been taxed in Canada, Canadian tax exceeds the US tax. That's great. The problem is that there may be penalties that the decedent not only failed to file the tax return, but failed to make certain disclosures. Those would exist with having bank accounts outside the US. I mean, what Canadian resident doesn't have a bank account in Canada? If those bank accounts exceed $10,000 in aggregate, they have to be disclosed to the IRS. Canadian corporations, Canadian trusts, Canadian partnerships, all these entities formed in Canada or in other jurisdictions outside the US require disclosure. The penalties for someone who's actually not worth a lot of money could end up being several times greater than the value of their estate. And the executor becomes potentially the person liable for failing to make those disclosures. And so executors, and there's no statute of limitations here for unfiled tax returns. So this is a hot button issue.
Mm-hmm.
So you want to jump to tax compliance?
Yes.
Okay.
So on the Canadian side, when a person passes away, normally you file return from January 1st to December 31st, but obviously if the death happens on October 15th, then you will need to file a T1, a personal tax return. Since it will be your last personal tax return, it's called terminal return. And that will need to be filed after you have passed away. And then all your assets are disposed of to your estate. And until the estate has distributed those assets to the beneficiaries, then that estate needs to file a trust return, a T3 CRA form, until for every year until the assets are all distributed. And if you have a situation where a non-resident owns a taxable Canadian property, one of the case that I was mentioning was that if the trust becomes a non-resident because of the way executor has been appointed to be, turns out to be the U.S. person, then the estate becomes non-resident. And if the estate needs to distribute the property to Canadian beneficiary, then you need to do Section 116 filings. Essentially, that is a withholding, a sort of installment that you have to pay on the property. Now, on the US side, it's pretty daunting. There are a lot of forms there, so I'll go through them, Warren, quickly, and you can jump in and say whenever you feel like it. There is IRS Form 1040, individual. It is similar to T1 in Canada. IRS Form 1041 for the estate.
So just if I can jump in right away here, and
Sure.
there's a lot here, and do you want me to actually talk through this?
No, you can give us a high-level synopsis here.
Sure,
Warren.
I'll do. So the 1040, that of course only applies for US citizens, regardless of where in the world they died. If they're a US citizen, it doesn't matter that they've never lived in the US, doesn't matter that they've never even made any money in the US. US citizens have an obligation to file a individual tax return. There's the exception would be if they're under certain thresholds for income, which now would be as low as $12,000, and in some cases can actually be lower than that. The interesting part is that when a US citizen dies, that does not mean their estate or trust has to file a US estate or trust return. So Form 1041 would be for essentially for US estates or US trusts. If it's not a US estate or trust, we didn't include the form here, it would file a 1040 NR if it had US source income. So there's a bunch of nuances here. The IRS Form 3520 and 3528, this again be for a US person, US estate or trust, with a non-US estate or trust interest. 8938 non-US financial accounts, FinCEN Form 114, this is better known as the FBAR for foreign bank account reporting. That would apply if it's a US estate or trust. So some of these forms wouldn't be required if it's a Canadian trust. On the estate tax side, it's Form 706 is a US estate tax return. 706 NA is for non-resident aliens, NRA, for their tax filing obligation. And that would be for a Canadian person who, for example, had US real estate or had, their copy of the Magna Carta in the US or something like that. And Form 709 is the gift tax. So the US has kind of a form for every occasion. It's nice to see that Canada seems to be doing the same thing, or seems to be getting close to that, but there's a lot of filing obligations on the US side. So that actually ends our whirlwind webinar through cross-border scenarios associated with US estate and gift tax and Canadian tax on death. If there's questions, you're welcome to put questions to us. Once you check off the webinar, we'll send you a survey. Please complete it for us. And thank you for attending. Now, I presume there's some questions here, Angie, for us, and we'll take some questions. It's almost 10 o'clock right now. So if people decide they don't want to stay for the questions, they're welcome to do it. But we'll try and answer a handful of questions here. And you're welcome to stay, but appreciate you joining us for that. Angie, what do you have for us?
Hi, thank you so much, Warren and Atif. We have some great questions and comments from the audience. The first one is, I am a Canadian citizen living in the US. My parents are Canadian citizens living in BC. I am their only beneficiary on their will. What should we do to prepare and minimize my tax obligation?
It's an interesting question. if you remember the example we gave here, that there's probably two primary things here. One is if he's the only beneficiary and he's also the executor, the estate is going to go from being a Canadian estate on death, where the decedent is in Canada, to where it's being managed by the U.S. person. It's automatically going to become a U.S. estate and cease to be presumably a Canadian estate. Now, again, this is a more detailed discussion needed on that. The second part is that if he's not the executor and it stays as a Canadian estate, and let's say there's, at death, there's 10 million shares of a non-US and non-Canadian corporation, and it's pumping out $500,000 of dividends each year, he potentially could receive $500,000 of income annually, tax-free, in both Canada and the US. So there's a planning alternative. You say, well, my parents, they've got $10 million of Canadian real estate, or they've got, $10 million in the bank account, but they don't own shares of a non-Canadian corporation. Well, that doesn't mean that the estate couldn't sell that Canadian real estate, acquire those shares in, a French or Bermudian or Italian corporation, and start to receive those dividends and get that lower tax treatment. So there's a planning opportunity here. Did you have anything to add on that, Atif?
No, just to say this, that depending on the facts and circumstances there, this can get a little bit complicated than what you have ascertained to. So it boils down to your particular facts and circumstances before we offer you any additional advice here that might be relevant to you.
Yeah, there's some opportunities here. There clearly are, depending on the facts here.
Right.
What do you have next for us, Angie?
Next one is U.S. estate tax only on estate in excess of 12.5 million or so.
Well, for a U.S. citizen who has not made any taxable gifts during their lifetime, that's true. It's 12.06 million in 2022. That goes up to 93 million. I can't remember 73 or 93 million. But in 2026, it drops down to 6 million. And so that number is going to change. For a individual who's not a U.S. citizen and not a U.S. domicile, U.S. estate tax split is on the worldwide income of U.S. citizens or individuals domiciled in the U.S. And domicile is different than residency. For those individuals, for example, a resident of Canada, the estate tax should apply over $60,000 unless, as a resident of Canada, they're eligible for the treaty, which then raises that threshold to, depends on what the value of their worldwide estate is. So if their worldwide estate exceeds $12 million in 2022, $12.06 million, they'd be subject to U.S. estate tax, but they wouldn't if it's under that amount.
Awesome, thank you. Next question. Canadian Family Trust, while being an American resident, required reporting on it to the U.S.?
Yes, I believe that. So Canadian Family Trust with which has become a resident of U.S. Angie, is that what you said, for tax purposes? So that would be become a, as we were mentioning in one of our slides, that will become a trust for U.S. trust for tax purposes. And then you will need to file all those list of forms that Warren went through.
Well, that's true. If the trust becomes a resident of the U.S., then it's subject to U.S. tax on its worldwide income. Where the beneficiary, I think that's what we said, is the beneficiary moves to the U.S. Is that right, Angie?
Angie, was that Ben?
Yes, I believe so.
Yeah. So if the beneficiary moves to the U.S., but they didn't control the trust stays a resident of Canada. Now we have a foreign trust for U.S. tax purposes. It continues to be a trust resident in Canada. And the question for U.S. tax purposes is it a grantor trust or is it a non-grantor trust? Now, again, this is going to go beyond the scope of this session, but I would say this, most Canadian family trusts are grantor trusts under U.S. tax law, which basically means that the grantor retains control. They can take assets out of it. They can receive all the income during their lifetime. You have to actually, when the trust was formed, take into consideration all the factors that go there. But if it's a non-grantor trust and the trust does not pay out income to the beneficiary on an annual basis, suddenly their complexity associated with that kind of explodes, because the U.S. is saying you're deferring U.S. tax on income earned in Canada or somewhere outside the U.S. We don't care what tax you paid on it there. You need to pay U.S. tax on it. So there's a whole series of issues associated with that, including an interest charge on the tax that's been deferred. The U.S. tax has been deferred. So that can become a very complex scenario.
So Warren, in Canada, we have rules called reversionary trust. Same idea that a person who has contributed into the trust can pull the assets out, has control over the trust, so on and so forth. So when we draft trust deeds in Canada, we make sure that it is not a reversionary trust if we don't want to be a reversionary trust. Are the guidelines pretty clear in the U.S. as well? So if they're Canadian taxpayers drafting a trust deed, they should, if they think there's going to be a non-residency issue coming up, they should choose the wording from the lawyer that sort of like addresses the grantor trust as well.
Well, I think I'd say that's true, but I'd say this: the U.S. rules are much broader on the grantor trust provisions, and that U.S. tax law, it doesn't say that the grantors have zero control, but it really means they have very limited ability to control what happens to the trust after they make the grant. They can't get those assets back. They can't, they can't receive all the income without it being treated as a grantor trust. That includes the spouse. So that's why, while it's easy to get around the reversionary trust rules in Canada, or easier, it's more difficult in the U.S. And you have to think too, did I really want to put my Mickey Mantle baseball card that's worth $10 million into this trust if my child misbehaves? I want to be able to get that asset out of that trust. And so it creates some unique issues there in terms of trust. It kind of forces the grantor's hands. Now, grantor trusts aren't necessarily all bad, but what you have to be careful is you want parallel treatment between Canada and the U.S. Having a Canadian tax law that says the beneficiary is taxable on it, but a U.S. tax law that says the grantor is taxable on it, it creates a double tax scenario. And so that's a challenge in those situations.
Thank you.
How about a couple more questions, Angie?
Yep, the next one is this is regarding slide 5. Is there sliding scale of death tax rate in the U.S.? What would be the rate if the amount was less than $1 million rather than 100 million?
There is a sliding scale, and they start at 18%. If you have an estate that's worth more than $12.06 million, you're already at the 40% rate. I can't recall exactly where it hits the 40%. I want to say it's just above $1 million. I try not to memorize some of these things, but they're there. So it's a fairly progressive rate structure.
Thank you. Next one, how many Canadian estates with U.S. securities actually file the required returns? I'm betting most executors don't even know about the issue. What are the consequences to not filing the U.S. estate return to the estate and or the executor?
Of course, we typically only know about people who do actually file because they come to us to assist with that. I'm not saying that all people do that. And I think there is an element of disregard, I think, associated with that does occur. The penalties can range based on a variety of things, and read the underlying facts. The minimum penalty, I'd say, would be $1,000. And that $1,000 would be because if someone has an estate that's under $12 million and they qualify to use the treaty provisions, they have to give notice that they've used a treaty provision to reduce or eliminate the US tax. And that penalty is $1,000. But depending on what other disclosures might be required, particularly with an executor who's dealing with someone who hasn't filed US tax returns, the penalties can go up astronomically. In other words, you could have a $50,000 estate that has, potentially $1 million in penalties. So that seems hard to believe. And there's actually a very interesting case before the Supreme Court right now, not on this subject precisely, but the subject is about a $2 million penalty being assessed against a US taxpayer and saying that it's excessive. And the Supreme Court will decide what excessive is. I'm not sure what the answer to that. It usually depends on whether it's excessively good for our client or excessively bad for our client. But yeah, there are penalties associated with that. And there could also be other penalties as well there. Of course, if there's tax due, and for example, there would be the tax is 25% of the tax due. If there's fraud, there's no statute of limitations. Whenever you don't file a tax return, there's no statute of limitations. So some of these executors may think they've gotten away with something, but it never actually dies, even though the decedent did. So thank you very much for your questions. You're welcome to reach out to us with other questions. Some of these we can answer simply. Some of them we may say, hey, if you need more assistance, we'd be glad to help you. We appreciate the opportunity to speak with you. And Atif, I enjoyed speaking with you together on this subject.
Likewise.
And thanks again, everyone, and have a great day.
Thank you, everyone.